All right. Good morning, everyone. Jamie, so nice to see you again.
Good morning.
Excellent. So let's get started. We are now on YouTube Live. So let's get started with everyone. Good morning, everyone, and welcome to the KoreSummit webinar series 2021. My name is Oscar Joffrey. And once again, we are going to have another fun session of education. I brought you some really good people today. Believe me, thank you everyone for all those questions, and I hope you're enjoying the videos. Even though you can't make it, I know first I want to say for everyone out there in certain regions throughout the US that are at the moment can't get in, we got your emails. Don't worry, all of this is being recorded. It's going to be available at our KoreSummit.io website and on YouTube channel. So not to worry, and we're always going to be here. Our colleagues this morning are going to make themselves available as they always have, and we're going to have a great conversation. But as a reminder to all those new attendees, our webinars are very, it's sort of like let's have a cup of coffee, sorry, and no PowerPoint presentations, ability to speak to those who are doing this day in and day out, and then for you to ask questions along the way. And so I'm really looking forward to this one. Because the last couple of weeks I have been bombarded with this question, and I know both of you have done this tremendously. But before we get started on the subject matter, let's take a moment to introduce yourself. And as they say, ladies first. Jamie.
Hi, my name is Jamie Astro, and I am with CrowdCheck. CrowdCheck provides due diligence and compliance as well legal services to companies who are doing basically any online capital formation. So we work in Regulation CF, Regulation Crowdfunding, Regulation A, and also Regulation D, as well as a variety of other services. And I'm also a lawyer by training, and I also represent a lot of our clients with respect to the SEC.
Oh, you are a lawyer then. I just got my.
Maybe.
I needed to.
On TV.
All right, Johnny, please.
Yeah, absolutely. Pleasure to be here with you both today. My name's Johnny Price. I lead the business development team at WeFunder, the largest regulation crowdfunding platform. I've been here for about 3 years and seen us grow pretty spectacularly. That in that time, it's been a really exciting, especially the last year for us, and coming into 2021 with the new rule changes that go live on March 15th. It's a very, very exciting time for us. Before that, I led the US lending team at a nonprofit called Kiva.org. We were also doing crowdfunding of more microloans for entrepreneurs. And then before that, I worked in strategy consulting where I started my career. I'm from the UK originally, but now live in Nashville. With my 3 young kids who you might actually be able to hear crying behind me in the background right now.
Well, me too. That's right. So welcome to COVID. I think, Jamie, you have a little one as well, your darling little girl. My 5-year-old is going to come here any moment because he always likes to wave to everybody. But you know what? We're in different times, which means that our children are part of our Zoom meetings lives today. So it's great. We're going to have a great conversation today. And, maybe the wording isn't correctly, but, we called it, what due diligence do I need for RegCF? And, we use the word due diligence because a lot of the times people go, okay, I just heard all I got to do is file this Form C, nothing else, and I'm ready to go. We're going to get into that. So I'm going to be going at it with each of you. I have kind of an outline, but keep this in mind. We can have a dialogue between it. It's not meant to be kind of rigid. The idea is, think of the audience. I want to do this. What do I need to do to get ready, both from each side? And here's the lawyer side and the platform side. So I'm going to start with the legal side first. I'm going to start with Jamie, because Jamie, quite often the client comes to a law firm like CrowdCheck to learn about Regulation C, and they go, well, crowdfunding, and they go, listen, I need your law firm to do the form for me. And I'm sure that's not the first time you heard that. So what do you need from a law firm perspective to assist them to get that Form C filed properly? Because I call that the due diligence, but please.
Yeah, so we actually, I mean, it depends obviously who they're working with and what platform, but for us, we have an onboarding form, which is, it goes through a lot of things like, describing your business, and we ask for all your documents related to the business, an onboarding form to get to know the business. And it's about, I forget, for RegCF, I think it's about 20 pages long. And because we need to be able to describe your business in this document, and we also need to understand your business and describe the risks that are going to be relevant to your business. So, when you go out there and sell an investor, like, your best protection is to tell investors, hey, these are the risks if you purchase my business. So, and then we also do due diligence along with drafting the document, because, anti-fraud provisions of the federal securities law, which includes section 12A, 12A2, and some of the relevant statutes do subject issuers as well as platforms to liability based on material statements or material omissions, if in the light of in the context that they put for what they say in these documents. So we want to make sure that our companies are protected from that. And then the other thing is they're obviously going to need financials. And then there's also what WeFunder will also help as well is they're going to start putting together marketing pages or campaign pages, which we can advise on from a compliance point of view, but we won't actually be drafting those.
So you said something that caught my attention there, and I'm going to pick it up and I'm going to come back to it. You have a 20-page document form that you want the client to fill out in order for you to do your creation for them, right? Which is, again, it's not just coming in, fill it out for me. It's you got to be ready to provide that information. And we're going to dig deep into that a little bit more. But, Johnny, from your end, obviously, you're not the law firm, but you, as Jamie alluded to, you have the same responsibility as the law firm does to do a form of due diligence or making sure. So what are you doing further than the Form C to complement it and to help that journey for the company to get listed?
Yeah, honestly, I think on the spectrum between being an open platform and being a VC that's kind of picking winners or setting the terms of the offering, I'd say we're probably closer to that open platform end. So we are doing a compliance review on the Form C. Obviously, we have our own kind of fraud checks and bad actor checks that we do. But I think we kind of generally don't want to position ourselves as kind of being the arbiter of whether this valuation cap should be 5 million or 7 million, or even whether this company should be raising on WeFunder or not. If let's say it's a coffee shop in rural Arkansas, no one on our team is going to be able to kind of say, this is a good investment opportunity or not. We just are not going to know that market well enough. So that's kind of the philosophy, I guess. One important product feature that we rolled out in 2020 to try to take a big step in this direction was around lead investors. So we rolled this out about a year ago now, and now every company on WeFunder is required to have a lead investor that serves a few functions. So we use a custodian structure to roll individual investors up to one line on the cap table, and the lead investor will vote for the shares of the individual investors in that custodian. So in the event of a follow-on financing or corporate action, the founder only needs to collect one signature, so that's good for them from the lead investor. But on the other hand, investors actually have representation, more so than they do if those votes are proxy to the founder, who might be being pressurized by a VC in a follow-on financing round, let's say. So we think that's actually better for both founders and investors. That's one role that the lead investor plays. But another one that's relevant to this conversation is around setting the terms of the offering. So the lead investor, average lead investor on WeFunder is putting in 25K. If it's a $5 million raise with the new rules, probably the average lead investor is going to put in significantly more than that. And that's an expert, right? An expert angel investor who knows the sector, knows this company inside out. and their verdict or their assessment on terms, as someone that's actually putting significant money themselves into the deal, is kind of the expert that we're kind of deferring to, and is leading here in terms of, yes, like, does this make sense to launch a WeFunder, and what should the terms be? When we first rolled out WeFunder, or RegCF, in May 2016, we were really kind of emphasizing the wisdom of the crowd. I think over time, obviously, we still believe there's a lot of wisdom in the crowd, but we also are looking to complement that now with wisdom of the experts. So another product feature is we have these expert interview panels, where a couple of sector experts will grill the founder for 10, 15 minutes on pretty deep questions pertaining to their business. So if it's a biotech company, for example, it will be, maybe investors in the biotech space that will really be putting them through their paces. And so we also will then share that and surface that to investors. So with the lead investor, the expert interviews, and other ways over time, we're trying to complement the wisdom of the crowd with the wisdom of the experts, but also not necessarily have WeFunder playing that kind of centralized gatekeeper role. That's, I think, what regulation crowdfunding and investment crowdfunding allows us to move away from.
Yeah, that's pretty interesting. Yeah, it's an interesting dynamic. It'll be interesting how it plays out, because that model we tend to see more on the accredited investor side, with investors that are not so much qualified, but they have a different way of acting and pursuing their grievances. The crowdfunding investor, I'm not so sure. I'm already dealing with an issue in this model where they feel like they got put into this thing and they didn't realize what it really meant. I want my rights. And it's really interesting. It's interesting. I do like the fact that somebody coming in and doing the additional due diligence. I think, due diligence, there's nothing wrong with it. I think in general, we as an industry, we want to make sure that these companies are coming well prepared. So you're going the extra mile, but hey, listen, there could be a lead investor in your deal with that expertise in that area. They're going to write a significant check as well, which is great on any level.
You guys will probably know this better than me, what other platforms do here. From what I understand, which is very imperfect, I don't know in detail what like a Republic or Start Engine will do, but I believe that this structure of a lead investor who is basically, trying to advocate for the rights of investors is industry leading in terms of kind of protecting investors. Sure, they proxy their rights to the lead investor, but I believe most other platforms are proxying rights to, for example, the founder. Say the kind of investors as a block maybe have less.
No, I'm not seeing that. I personally look, the thing about the crowd that is very taking the traditional model from due diligence, making it easier. Okay, Form C's done that, and I'm going to get back to you, Jamie, on that a little bit on that question. But from a shareholder point of view, we see something else in the back end. What we see is confusion from, I thought, so here's one we're dealing with now. I thought I invested in company ABC. How come I'm being invited for, wait a minute, what is that, LLL? What does that have to do with? Then you have to explain it to them. And I know when we go to see the offering that's exactly how it was described, but nobody really understood this investor. This investor's emotionally purchasing in. They never saw the fine print of the LL. They just see, because all the marketing was done on this company. So I'm cautioning that element because this audience is still, young. We've only got 5 years. We've only touched 358,000 of them so far. There's 233 million more to come, which is great. And we have a lot of education to do. So I'm all for testing different models, but I see it after the fact. And this is where the consequence, and the one thing that's different about this particular investor, they take their grievance to social media. Not like an accredited investor calls Jamie and says, Jamie, I want you to call it's kept in quiet. This investor takes it out there and then it starts creating, and we've seen what can happen when the crowd gets together when there's a misunderstanding. So, but I'm not judging one way or the other. I'm just it's an interesting model, and I'm glad to hear it, that we're testing new things. And what I've seen, I can only go by what we've seen. We haven't seen the model where the platform becomes the proxy owner so far. The new platforms that we're also working with, not a single one has that in mind. They want to be like yourself. We want to be agnostic, so which is good. But this is leading us to the whole issue of, the due diligence, right? A lot of them, they're either going to go too far, and that's a problem because that's not really your role. But then there are services that companies can retain. So I'm going to come back to you, Jamie. As I said, you mentioned that form. You said something in there as well, that one of the things that you do with all that information, you're also creating an independent due diligence report. I did get that correctly, right?
Yes.
So that independent DD report is something that the company can use when going to funding portals or providing it to investors. And I've seen it in certain, so that's giving a third party DD to the investor base at large on what you see in the company. Can you explain that a little bit further?
Sure. And I will state that our, due diligence report is for legal and corporate governance compliance. It's not going to be, as Johnny mentioned before, valuation. We don't get into valuation. We're not business experts. That's not where our report is. So what our report does is we kind of go through the company and kind of make sure that their housekeeping is in order, right? It's not unusual that, companies come to us, especially in RegCF, where they're like, oh yeah, I just use LegalZoom or whatever, have a company, did bootstrap some of their documents and don't have any corporate formalities, or what they do have is incorrect. Or sometimes, what they're trying to sell doesn't necessarily make sense for them. So we can help them with that. Or not knowing what they sold previously, right? Companies might have sold safes and not understanding that their safes only convert into preferreds, or what their safes do, or the safes have terms that don't actually make sense. Someone in the company, fudge with the document a little bit, and we can't even understand a little bit what they've previously sold. So a little bit of cleaning that up through the process.
So Johnny, so when I hear this independent report and I look at that from the two models you have, where the lead investor, the non-lead, the independent report help? I mean, that could, it gives even further confidence, would it not? I'm just curious if that helps.
Yeah, I would imagine so. I mean, third party kind of, review and assessment from a law firm like CrowdCheck, who are experts in this equity crowdfunding space. I don't know. We don't have any data. Would be a cool A/B test to run. To kind of show 50% of investors the CrowdCheck kind of seal of approval and 50% not, and see what the increase in clicks and investment volume is. But
that is a good suggestion.
Yeah, I was going to say, anytime you want to do that.
No, but he's right though. But Johnny, you touched on a really good point. We're growing up that in the Reg D world, it makes a big difference, and I just want to touch on that because I know we're laughing about it, but I think that's a wonderful idea. What difference would it make to this type of investor knowing there's a CrowdCheck report, like an independent third party? Would it allow them to say, I'm going to put not 100, I'm going to put in 1,000? Does it? Do you know what I mean?
Yeah, absolutely. I would love to be able to do more A/B testing. It's kind of tough, right? Because if the CrowdCheck report has been kind of made and provided to a founder, then you better believe that founder will want to show that to all their investors, right? Because obviously it's going to increase confidence and investment volume to some extent. It's just the question is that 10% or 100% or 1%? And so, so then the founder will want to show it to everyone. And so it's tough to operationalize an A/B test, but over time, hopefully, as the numbers get bigger and as kind of bandwidth on the product team grows, hopefully we can do some of these tests. Another A/B test I'm always curious about is minimum investment size. I'm always advocating for founders to go for $100 minimum on WeFunder. We allow a range of $100 to $1,000. And if you go for $100, you obviously going to have a lot more invested, and that's kind of what WeFunder is all about. But does that mean that obviously average investment size will come down, and does that mean you'll raise less money in aggregate? And so again, would love to run an A/B test there, but it's kind of tough to.
You're
one day.
I'm tracking all of that right now, not so much on RegCF, but on Reg A. Does it make a difference whether your min is 100, 500, or 1,000 psychologically and all that? And
with an A/B test,
right? Yeah, in Reg A.
So what's the answer? If you go from $100 minimum to $1,000 minimum on a Reg A, what's the delta change in aggregate investment volume?
You're gonna love this. So the amount of hits you get on $100 is more than 100 to 1 to the 1,000. The 1,000 comes in and leaves.
No.
So
but that doesn't make any sense. There's no way it's going to be 100x difference in conversion.
But again, it's. I'm not talking about monies coming in, but I'm just talking about people coming to the site seeing 100 versus 1,000. There's an expectation, I believe, when you're targeting the non-accredited or the market at large. It's a psychological look. It's no different than when we go shopping, right? You have this perception in your mind that I saw an ad somewhere where I can buy a TV for $29.99, and you go to two sites and you got one at $29.99, the other one's at $199. You go, no, it's a 20, and even though it could be the same TV and it is $29.99, but they made it. I think we need.
My guess
more
would be
work.
3x. My guess would be 3x the number of investors if you lower it from 1,000 to 100, but the total dollars would be slightly higher for $1,000. But that's total guess.
Yeah, we got a ways to go on that one. So, but we're learning. So,
Oscar, I'll plug in for you a little bit, because I mean, on this one, as a transfer agent, well, you guys obviously your costs are much we're good with this, but as a transfer agent, some of these things, if you have $100, means you're going to have a lot more investors, and a standard transfer agent, and you can talk a little bit about CoreConnect, is going to charge a per investor fee. So your $100 might end up being significantly more expensive in the long run.
Thank you, Jamie. I appreciate that. That is true. The traditional model punishes you for having more. We have a different view. We want you to have more, right? There is one client that I really enjoy. They're shooting for $1 million. I mean, they give me a heart attack every time, but I love it. I think it's exciting. It's everything the JobsApp was created for, right? It's a client of yours, Johnny. It's a client of Jamie's. We all share that client, and I love their journey. They are the poster child of both Regulation CF and Regulation A and their objectives. So thank you for that note. So obviously we need more work. Obviously, we need to know what these independent report, like the one from CrowdCheck, could have an impact. And you're right, Johnny. The point is, if I have a positive report, I want everybody to see it. But obviously, from a curiosity, we all want to test it. But we will find a way. We will find a way. So obviously now, I want to pick your heads without obviously going into client. But what are the roadblocks that you often see when you're creating this, when you're working with an entrepreneur, Jamie, and they're coming to you, they're ready to go, you give them the 20-page form. What are the things that are coming out constantly over and over again that they're unprepared for? Or they go like, wow, I didn't know I needed all this, right? I heard it was so simple. Just curious from your point, what do you see?
And I think it depends on the client. I mean, obviously, one of the big roadblocks, so for RegCF, it's not as big. For the first time you do RegCF, you can raise the full amount on reviewed financials, is getting your financials in order. And for some companies, that's easy peasy. I just started yesterday. I'm a man or a woman in a garage. I got a zero balance sheet. Great. For other companies, they've been operating for a while. Even if it's just a review standard, they might eventually want to go a Reg A or do a RegCF later, a subsequent RegCF where they will need audited financials. It's, they've been operating for years. They've been operating on a cash basis. They have to move to an accrual basis. not necessarily like they don't like, it ends up being a significant heavy lift for them. And we like, I can speak on the audited like framework. Like there are times we start with a company and they kind of disappear for like 4 or 5 months until they get their audit in check, right? Like in going through the process, especially if it's, a company that has been in operation, has lots of small sales, like, is in an industry that like not everything is online or computerized. Like, you were talking about a coffee shop. A coffee shop could be a really heavy lift depending on what their receipts and what their books look like. And then also just, talk about like, you're right, like, making sure when we onboard them, understanding, hey, this is not, just a one side. You can't just say, what do we do? Coffee shop, and CrowdCheck's going to put together a document for you. It's going to be a heavy lift for a lot of the companies as far as answering our questions and understanding where they are, and also kind of going through, lifting the lid and kicking the tires, the due diligence process, understanding how their documents are and like, what sort of corporate governance they've kept in place and where they need to go, and understanding that the process could take a few weeks or it could take several months, if not more, depending on where they are, like, mainly do the financials, but like where they are.
That's great insight. I mean, it's helpful to everybody, that preparation, right? And you're right. I'd say so many are just, hey, I'm ready to go, boom. And Johnny, from your end, are you seeing the same kind of roadblock, the financial side, or is there other elements that you've seen outside of that become kind of barriers to going live or approving them?
Yeah, I think the financials is the main one. Yeah. The gap financials, like converting from cash to accrual, obviously, especially, it's like a brewery, for example, a Main Street brewery with like a ton of transactions, and not to stereotype, but maybe brewers are not the best bookkeepers. So, it depends on the founder, how clean their books are, how complex their books are. So yeah, that's usually the long pole in the tent. I mean, one thing we're really excited about is testing the waters, right? I think that's gonna significantly expedite the time to founders kind of starting to fundraise here. And so I do think that will significantly increase the number of companies that are trying to explore raising in this way.
Yeah, exactly. They can test the waters, and it'll help. Hey, you got to get your books in order. Hurry. There's becoming a bit of a demand. So let's move forward, because I mean, we've had a few years raising up to $1,070,000. I always get the crackle of that, and filing the Form C. So Jamie, I mean, CrowdCheck, the firm with Sarah and the team, and Andrew and yourself and many others, you guys have a really good pulse of what's going on at the SEC. Do we anticipate the Form C being amended in any way now? Because $1 million and $5 million are not the same, right? I already see a different type of company already coming into the space. So is that going to change the due diligence component now that we're going to see real estate? Real estate is going to be a heavy, one of the major assets. Do you see any of that coming?
So I don't think I think the SEC regime right now, and then I could be wrong, and I don't have any insight into whether there are going to be changes to the Form C, but the disclosure requirements are good, like, at this point are pretty good. It's, it's more of a matter of compliance with the disclosure requirements that already exist, right? Like, so you could have disclosure requirements, but if people aren't actually like, following what they're supposed to include, or like not including enough, then obviously, garbage in, garbage out. But I don't think there necessarily needs to be changes to the requirements themselves, but I think people really need to start like focusing a little bit more on making sure that they're more compliant and like, really like, following what needs to be disclosed, and understanding a little bit on, look, companies could potentially be liable for it, issue, like, you need, like, if you worked on it, like just making sure you understand what it is. And when it increases from 1 million to 5 million, it's not that the regime has changed, but like your exposure might have changed.
That's a great point to say. The regulars are going to pay a little bit more closer attention. You're taking in more money, right? And it could be more holders. Johnny, from your point of view, I mean, obviously you're hearing from lawyers, the form isn't going to change it. Is there anything going to change from WeFounder's point of view, the amount of information, or you can follow the same process regardless of the dollar amount?
Yeah, I think so. Like I mentioned earlier, with the expert interview panels and the lead investor, those are two very important, I think, excellent product innovations that we rolled out last year, that are trying to, kind of just provide more and kind of higher quality information to investors. And by higher quality, I mean, obviously, I think it's great that the SEC mandated, 2 years of GAAP financials are going back to incorporation date of the company. That's great. But the biggest thing that keeps me up at night is investor protection and investor returns, and or not necessarily returns, because, this is startup investing, right? Like probably the majority of investments on platforms like WeFunder will go to zero over time, right? If you look at venture capital investing, right, like even for more established companies, probably majority of the companies might go to zero, right? And then the one Uber in the fund, the power law returns the whole fund. So if a power law distribution means that the millions of investors who invest in WeFund on aggregate make a 10% IRR, like from one, the next Uber IPOing, then a lot of those investors who are just making one investment are going to lose all their money. So not necessarily investor returns, but certainly kind of, are investors going into this with their eyes open? Do they understand the risks? Do they understand that this is a pretty illiquid investment? And that's kind of really what keeps me up at night, above all, in this model, working at WeFunder. But so what I meant by high quality before was, for me, an expert interview panel, a video that you can watch for 10 minutes, where experts in that sector are asking founders hard questions, or a lead investor, like a leading angel investor in that sector who's putting in 100K on the same terms. Those things are great examples of, quotes, due diligence or relevant information that is communicated in an easy way. Because you can have like a lot of kind of detailed disclosures, but we know, like, a lot of people don't read, and sometimes the danger with kind of bubbles might be that people kind of follow each other like sheep. And so trying to present the right information, but also in an accessible way, is a hard challenge. It's like a product and design challenge, I think, as well as a kind of legal and kind of financial due diligence challenge, if that makes sense.
No, it does. I do like the expert panel. I have to tell you, that is, I like the fact that a company has to go through kind of a review, an independent group of people, experts that are in that area, like biotech or, consumer goods, in particular now, because, well, one, we're increasing it to $5 million. It's not just, and you're right, investor protection has to be at this most. So we got to ask more in-depth questions. But not only that, we're introducing a brand new investor into this pool who can write a fairly significant check, and traditionally would rely on a broker dealer to do that due diligence, or a major lead investor writing a check bigger than 25,000. So obviously this puts us all on kind of, not so much on notice, but saying, hey, listen, if we want to attract both investors, we have to provide that new level. I think what's going to happen is platforms, to be able to attract that new audience, meaning the accredited, which in most cases they already have, but to attract more of them and to write bigger checks, which now they can under the new regulation that comes into effect on March the 15th, will be these kind of things that you said, Johnny, is that an expert panel is just one more thing. Okay, good. Somebody else reviewed it with more expertise than I have. Good. The CrowdCheck report, good too. Versus, I'm not really sure, this is I don't know if you guys saw this. There was a report done by, not Crunchbase. Oh my goodness, the other one's going to escape me right now, but I'll come back to their name. But it's the PitchBook. That's what it is, about crowdfunding, regulation crowdfunding. And I need you to understand why this is important. Because up until recently, they had never written a single article about crowdfunding. They didn't think it was important. But for the very first time, they feel that Regulation CF will tap into their Series E round. So back to your point, Johnny, that structure, that type of investor is looking for a lead investor, right? Maybe the checks will be bigger than 25, which is even better, right? It will then become kind of the follow-up. And if we can educate that industry, the market at large on that, what do you think of that? I mean, did that change the model? Obviously, you guys have thought of that at WeFunder, Johnny.
Yeah, absolutely. And the lead investor is the average check size is 25K. So there's a lot that are significantly more than that. And it's a signal on the campaign page how much the lead put in. So if you're raising 5 million and your lead has only put in 25K, I would say that's a negative signal, right? Versus if they put in 250K. Yeah, and with the 5 million cap, I mean, one thing that's cool, I think a big part of like investor protection or at least more kind of actually investor upside and investor returns is, can we get the next Uber on WeFunder as opposed to, raising from angels in a Reg D or VCs, the more conventional fundraising approach historically, right? And so one thing that I think is cool is that, I was chatting to a Y Combinator company the other day that the founder told me, at 1.07 million, not really worth it for me. But at 5 million, all of a sudden, like RegCF becomes more attractive and the benefits outweigh the costs. And so now, okay, we're going ahead and launching with them. And so, that's a good example for me of where these rule changes, I hope, will help get more of the very, very best founders using RegCF, which ultimately, I don't think there's anything better than that for driving long-term, investor kind of returns and ability to participate in the upside here, which is, I think, what we're all excited about, right? It's like, why should the wealth created by the next Airbnb all accrue to the top 1%? let's spread that out more broadly.
Agreed.
But you need to get the next Airbnb on RegCF in order for that to happen.
100%. And now we can actually, and we're not going to talk about secondary market trading, but at this call, we other webinar on that. And Jamie, from your end at CrowdCheck, obviously we now bring a new element into this picture. That element was there before, but it had the same restrictions as everybody else writing that smaller amount of check. Does it change I know I'm putting you kind of on the spot, but do you think it will change the CrowdCheck report, the D report, given that the audience now is going to be an accrediting investor? Do you think you're going to enhance it any further, or is it just it is what it is and that's it?
I mean, we always like to enhance things based on feedback, based on client needs. I don't think so, because our RegCF report is very similar to our Reg A report, which also which was up to 50 million ahead of time. So we're not going to really modify unless we get feedback otherwise that people are really looking for this information. We're not necessarily going to modify our report. And I will like to say, I echo a lot of what Johnny was saying, hopefully, because the limit has increased, it's going to be a way for, bigger companies to really, a little bit more established companies to really start trying RegCF, and then use it maybe as a gateway to Reg A or other financing in the future, where everyday investors can get the same opportunities.
I mean, just to double down on what Jamie said, it should not be the case. This is a little bit naive probably, but in my kind of idealistic world, it shouldn't be the case that accredited investors have the extra level of due diligence than non-accredited investors, right? I think that's
agreed.
Yeah,
agreed. The one you both said something really interesting that I do too agree that we're going to see a very different type of company coming into Regulation CF that hadn't come in before, because as Johnny's point, for 1 million, it's really not worth my time. You got 5 million on the table. Well, wait a minute, this has changed. But here's my only fear. So I do have a fear, and because I'm 11 years in. Sarah, I'm sure she's 12 and 13. I'm 11 years into this, and I love it. I believe we're just getting started. I believe we're just getting started. We got a great momentum going, and we cannot forget how we got started. And I want to touch on this because a little bit, because we saw it in another industry many years ago. I saw it in the lending business. So crowdfunding lending was a major success, where the crowd came in, put in the dollars, and allowing everyday other people to get loans. And people would play the banker with a middleman in between, or help businesses and all that. But these things became such a great success that they started taking institution money. And within a period of less than 5 years, the crowd now is gone. So the crowd is back to where it was, and it's institutional money being used here. So why am I coming back to this? My only fear in all of this is that I hope we never forget that company that raised 10,000. See, I really, it's gonna, it's gonna sound funny, but no, hopefully not. I like my very first RegCF client because I'll never forget who they were. $10,000 was everything this lady needed. That's it. And her business was able to get started. I think that in itself was the Jobs Act. And I also have billion-dollar companies raising 450 million, one almost 1.5 billion, and everything in between. And I'm proud of all of that. I love the journey. I'm an entrepreneur, so I swell on it. My only fear now is, are we going to take our eyes off the company that only needs 50,000, not to get the coffee shop started, but to get that dress shop started, or we're just going to go, hey, they want 5 million. This is the better play. The report.
So I can talk to that from the WeFunder perspective. Actually, also from the Kiva perspective. So before WeFunder,
Kiva, of course.
I founded the Kiva US team back in 2011 and grew that for 7 years. Actually, several of the people who worked with me on that are now at WeFunder. So I think for us, it's like very much in our DNA, But Kiva's a great option, and now I think up to 25K. 0% interest. That's loans, not equity. But if you're only raising 25K, I would say probably a loan is a better option than kind of adding the complexity of different kind of owners of the business anyway, and dealing with kind of ongoing profit distributions, etc. So I think Kiva is a great option. Honeycomb Credit, great platform in Pittsburgh that do debt raises focused on Main Street businesses less than 50K. WeFunder starts at 50K, but I mean, we are going to have a lot of companies in that range, I think, and more kind of, again, Main Street small businesses versus venture backable tech startups. Although even tech startups, I think this is a great way to do a friends and family round. It's a super efficient, streamlined, supercharged way to do a friends and family round. But a lot of these 50K raises are going to be Main Street businesses. And one thing I'm excited about with these March 15th rule changes is testing the waters, right? So again, for an independent coffee shop with cash books that are a mess, right? To pay for a CPA, well, I guess not a CPA review, but if they're raising less than 250K, but still, to get their books into GAAP format is like a big pain. And they don't even know if they're going to be able to raise the 50K on the platform, right? So now we're testing the waters, they try to feel it out, get a sense of that. And then if they are raising, they kind of are getting up to that and they feel more confident that this is going to be a success, then they can commit to doing the GAAP financials and filing the paperwork and doing the Form C. So I think, 5 million is one aspect of the rule changes, and take your point, Oscar, that might kind of be a gravitational pull towards larger companies. But I think testing the waters is actually kind of really kind of open up the floodgates in terms of like who is going to be able to launch a campaign and potentially use RegCF to raise smaller amounts of money. So I think at both ends of the spectrum, these rule changes are very, very exciting.
Yeah, and I'm glad to hear that from you, Johnny, because I think about this a lot lately, because a lot of the platforms the new ones that I'm meeting. So what's your target? Well, we're really going after the company that's going after 1 to 5 million.
Yeah.
But the Jobs Act was for everybody. I know, but we found 100%. Our sweet spot.
I'm with you, man. I'm with you. This is my background.
It hurts me. It hurts me to hear that. You know what I mean? Because it's not what we all intended it. And so glad to, obviously, Jamie, for you, clients is a client if
right.
They want to.
A client is a client, but at some point it's not economical for them to use us if they want to raise $10,000. And like those and I think those people still need to have access to the capital markets, but like, they need to, like, WeFunder and some of these places have been good with some turnkey functions, right? Like, where anybody can just show up, but you just want to figure out, what they should be selling and like, get good advice there, because
Right.
it's someone who raises $10,000 doesn't want to get like, whatever, how many clients would it be? 100 investors at $100 each, where then like, they don't have necessarily a good exit. These investors then have this illiquid security. They have to think
Right.
about what they're doing with these investors. They have 3 years of maybe not 3, but maybe 1 year of ongoing reporting requirements, and just have compliance and updates that might be far in excess of what they really need to do, where like,
Right.
there might be other options like Kiva, or like, or there might be different securities that make sense, like, some sort of revenue share for like, the coffee shop where people get their money back and they don't always have to stay with the company. And they like, they're not going to end up being lifelong equity holders in the company.
And that's a good comment, Jamie. That's very good. You don't always have to offer equity. There's different models to get your financing. Not everybody needs to be $1 billion company, but that doesn't mean you can't give people a return. This is VCs say the reason we don't invest in the rest of the market is because they're lifestyle companies. I totally disagree. I'm very proud that the fact that we have a number of unicorns that came from the crowdfunding, and crowdfunding made them unicorns, not venture capital. I think they both need to work together. I think this is the era we're in. We can't say one is better than the other. I think both of them working together gets a company even further. There are some lifestyle companies, and that's fine. Those are well known, but I always want to make sure that everybody has an opportunity, because are we going to create a new advocacy group saying, look at this, all this is good, and are the little guys are getting left behind, right? So that's it. The fear that I'm having is, Karen Carrington creating from the Small Business Association, doing a search with all her members and asking them, so how are you liking crowdfunding road? Well, that was great, but now I'm too small for them, right? So I already know there's at least 15 platforms that are coming live that will not do anybody under $1 million. And I want to echo the message to everyone that that's not the case. WeFunder, obviously 50,000, that's not unreasonable. I mean, it's slow. You can do a lot with 50, but there are going to be others that as well with WeFunder that are not going to push away that, because your roots got started at that point, right? That's how you guys got started. As well for CrowdCheck. I just want to make sure it's even. But with all of that, I think Jamie nailed it. You still need to make sure that you meet all your the obligations associated with whether you raise 10, 50,000, 300,000, whatever the amount is. Nothing moves away from the disclosures or anything, right?
Exactly. But I will say you're talking about platforms that are like, looking only in the $1 million to $5 million range. There also might be platforms, we haven't seen that many, like, that at this point, that might be looking in the niche markets too, where like, someone who wants to do X might get lost in one of these larger platforms potentially, or potentially not, right? Like, because they only, they're a neighborhood coffee shop and they're handing out napkins to everyone who passes by to be like investing, and their investors are going straight to them. So they're not going to get lost in the mix. But you might have platforms that might be, hey, we're looking for, something very niche, right? Like, and people are going to know this is where my business can get money because this is the place for me to go.
This is a good point. Good point. So obviously we're getting to the point. I mean, I'd love to hear your closing remarks. Obviously, the whole idea was people hate that word, due diligence. I don't think it's a bad word. We need to onboard you, and in order to onboard you, you need to be prepared. Johnny, I'd like to give you a couple minutes to tell everybody. Obviously, you guys are really open. You guys have been really great. You take on, like, you're right. You take on everybody. You don't discriminate, which is fantastic. And with the new models, so. Your closing remarks in this discussion from onboarding, but you would give them the 3 high-level points for everybody who wants to come to WeFunder to apply.
Yeah, absolutely. I mean, just to give a shameless plug, as of March 15th, you can raise 50K to 5 million. on WeFunder. So anywhere in that range, if you're the small business that Oscar's talking about, all the way through to the, startup and doing part of a Series A on the venture capital path. And yeah, wefunder.com/raise is where you can go to kind of learn more. Our FAQs are really great. And then the process to set up a campaign and start raising money, I think especially with the new testing the waters regulations, is going to be pretty easy. And obviously, the lion's share of the money usually is going to come from people you bring. So it's definitely not the case that you put up the campaign and watch the $1 million roll in from the WeFunder investor network. You'll have to find the lead investor, and the more they're investing, the better signal that is. You'll have to get your community, your LinkedIn connections, friends, family, customers to invest, and then the more you can bring from your network, then the more exposure you'll get, and typically the more you'll bring in from the WeFunder investor base. But would love to obviously chat with any founders that are considering raising money in this way.
Thank you. And it wasn't a shameless plug at all.
A little
no shame. No shame in telling people what you guys are doing, because it goes without saying, you guys have been leading it. The leadership there has been, look, you're still there. You haven't given up on anyone, and the fact that now it's getting increased to 5 million, it's only going to make it bigger.
It's going to be an unbelievable year. 2020, I think the whole industry grew by 2x. The Q4 WeFunder was up 4.5x on Q4 2019. But if you look to 2021, I mean, with these rule changes, it's going to be absolutely explosive. It's really very exciting, I think, for all of us. And that's cool because, the more success stories, I think there's still some reticence, right? Like it's a new thing. It's not like the tried and tested path. There's still some lawyers out there that are kind of skeptical of companies raising capital this way. But the more companies do it, then I think a network effect will kick in, where more founders on platforms like WeFunder is better for investors, and then more investors is going to be better for founders, more eyeballs we can put them in front of. So it's like a two-sided network effect, which is powerful. But then also the more success stories there are, the more great companies now that are using it because of the 5 million cap, then it will just start to become more and more commonplace. And I think our vision is, in 5 years' time, it'll be an absolute no-brainer to do your seed rounds, where you give your customers and your community and your fans a chance to become owners early on, as well as, or even instead of, millionaires and billionaires and institutions. And it will just be so common that it's it's kind of a weird move not to do that. I think that's the vision we're shooting for.
It's funny. Yesterday I had Samson Williams from CFPA, and he was referring to them investors. So investor, customer together, which is, we've been talking about that since
Why
the
on earth
beginning.
would you not want your customers to be owners of the company? Then there'll be more loyal customers and more passionate brand ambassadors. I mean, it's logically pretty obvious to me. We did a case study I read a blog on Kingscrowd that showcased an example of NeuroHacker, who were a B2C company sold exclusively through their website. And they anonymized their sales data and then shared it with me. And we saw two things. One, they had people that were not previously their customers who then invested in the WeFunder campaign and then went on to become their customers. And then secondly, people that were existing customers that invested in the campaign went on to spend much more money and have a higher LTV over time than customers that looked pretty similar but didn't invest. So increase engagement with existing customers, acquire new customers, especially for B2C companies, but for B2B companies as well. Why would you not want that? I think that will become more and more obvious to founders over time.
Yeah, it is an exciting journey. Like I said, I'm pumped. Obviously, Jamie, ladies first, ladies last. I'd love to hear your last comments on this. Your RegCF form. Obviously, I think that would be such a great guide to put out there already for people to get them ready. I really believe in preparation. So the floor is yours.
Yeah, and I'm going to echo some of what Johnny said. Like, I think we're entering a really new, exciting space now. But and also agree. I like that that what's it called, neologism. What was that? The investor customer neologism. But yeah, um, I think for RegCF, it's one of those, you have a lot of companies and an ounce of prevention. Like, it's easy to fix corporate boo-boos or corporate mistakes, now than later on, or making sure, like, working with a team that can make sure, like, make sure you're not, I'm not going to say you're not going to make mistakes. You're an entrepreneur, you will make mistakes, but can at least help guide you into some of the best practices as to what you're reselling, and making sure that you don't overstep your bounds, because I think there potentially will be an increased spotlight on it when you go from 1 to 5 million and the $5 million companies. And all you're going to need is a couple $5 million companies that are hopefully, knock on wood, not bad actors, but like, get some bad press where, like, it might, like, make the market wary. So just keeping people in line. And look, there's no way to prevent fraud. There's always going to be fraud, but, like, really we're here to help good actors, like, not get in trouble later on.
Well, that's great. Both of you, we had a great chit chat. This was, I'm going to come back to you on that form though. Again, the better prepared they are coming to you, to Johnny, to everyone, it just makes it, I know Johnny, most of the time,
And one point just to add on that as well, we think CrowdCheck are awesome, best in the biz, like brilliant, like just know this stuff inside out. We actually had Sarah on the WeFunder podcast. We called it Sexing Up Securities Law. The title of that podcast, so check that out, fellow Brit. Good
to know Sarah made it.
Yeah, but just big endorsement of CrowdCheck if you're looking for lawyers, as you're considering a Reg A or a Reg CF. Would highly recommend Jamie and Sarah and the team.
And I should say, feel free to reach out to me or go to crowdcheck.com. I will do my shameless plug. And then I also wanted to echo one of the things Johnny said at the beginning, which I think all people should be aware of. When you get into this area, and TTW would be great for it, securities need to be sold. They don't sell themselves. So, I think, have everybody from clients, from investors to the companies having the right expectations also makes the process go a lot smoother, and, like, gets everybody in the right mindset for things.
Perfect. Thank you. This is enjoyable. I'm definitely going to hold you both to your comments today. We're going to, the journey begins March the 15th. Literally, we're less than 30 days away. It's going to be an exciting day. We're going to have that whole week of March 15th. We're going to have an exciting lineup of things to come. And I think it's just the right spark that we need to get 2021 going even further. Thank you, Jamie. Johnny, it's good to see you both once again. For everyone else, we'll see you again soon at 3:30 this afternoon in the next webinar session. If you want to see this webinar again, it's at KoreSummit.io website or the YouTube channel. We look forward to seeing you